Welcome along, everybody. Good morning and good evening, good afternoon, wherever you are in the world. So welcome along. This is, of course, our the Portal Asset Management's webinar series. It's all part of our education process. We educate both those that follow us and, of course, ourselves along the way too. And we do that by having monthly webinars. And we also do it by having weekly podcasts, which are in the name of Beyond Bitcoin. And Nitin Gao, who's with us there on the screen, who's our CTO, sits with me and does those Beyond Bitcoin podcasts. So you probably know, just very briefly, that Portal Asset Management is the founder and advisor to 3 funds in this digital asset space. Those 3 funds are essentially diverse funds across the space, but they're based on different levels of volatility. So our flagship fund, which is the Portal Digital Fund, relatively low volatility that sits at around 25% vol, and we've been operating that for a little over 2 years now. And by the way, it's performing well in these downward market times as it's meant to. And our Radiance Multi-Strategy Fund is the fund that's coming now, and that fund is designed to be a medium volatility fund, 35 to 50% volatility, which is medium across this space, of course. And that fund, again, diversified strategy, investing in the best of tokens in the main sectors and with some hedging and some early stage tokens. And finally, the Horizon Fund really is an equally weighted index fund. It's domiciled in Australia, and it's the top 25 tokens, less stable coins, and of course, high volatility across the space. So that's the way that we look at the space. It's the way we want to get spread across the space. But there are many ways of entering this space. And today our speaker is with us, who is going to talk about VC investment in the space, which we think is, tremendously important. In fact, it's the driver to this space. And of late, we've seen extraordinary monies going to VC. Some $41 billion in the last 15 months has been invested in this space. And VC is also what I would call an eyes up long view in the space. And that's very important because at the moment, of course, we're seeing lots of downside volatility, and it's a good way of having a vision going forward. So I'm going to introduce Mark Witten, who's our CIO, and also who's the manager and adjudicator for today's event, and he will introduce our guest speaker. Over to you, Mark.
Thanks, Derek. So thanks and welcome to everyone. Special welcome and thank you to Prashanth. Prashanth is a partner and the head of institutional business at Woodstock, which is a fund focused on the decentralized ledger technology, VC investment in that space. Prashanth has a very impressive background. He has over a decade's experience in traditional capital markets as a senior leader with Morgan Stanley initially in London. He's worked across both public and private markets and focused on risk management, structured products, M&A, financing, advisory. Prashanth helped Morgan Stanley and a lot of their clients achieve to effectively manage and exit capital intensive and non-performing debt positions post the GFC in 2008. And he's also worked with regulators across multiple countries, as well as private side participants and private equity firms. And around the end of 2018, after a decade with Morgan Stanley, which feels like time served, Prashanth became an entrepreneur to work in the digital asset space. And he's built a couple of digital asset businesses prior to that from the ground up. So he has an MBA from the Indian Institute of Management, the IIM, and a Bachelor of Technology in Civil Engineering from the Indian Institute of Technology. So that's a very impressive credentials. So thanks very much for joining us, Prashanth. I think just if you wouldn't mind, I'll stop the screen share. I'll bring it back. This is the only really slide I wanted to show was the growth, as Derek spoke about, in VC and private equity funding over the past, call it 18 months. We've seen roughly 30 billion in last year in VC funding, and then first quarter of this year, 12.5. So if the trend, which looks like it's set to continue, we could see, I wouldn't say double last year's numbers, but we could definitely see a good 40 to 50 billion this year. So I'll stop there. I'll stop sharing now. And I think maybe, if possible, would you give us a bit more insight into your background and how you managed to, how your career has evolved into from where you started at Morgan Stanley in the traditional financial markets, what you saw that really attracted you to the space, and then how you've your role at Woodstock.
Sure, thanks, Mark, and thanks a lot to everyone for having me here. It's quite a pleasure to be part of this panel here. Funnily, I seem to time things pretty bad when it comes to my professional career. So 2008, when I joined Morgan Stanley, this was I joined the team that was doing securitizations of residential and commercial mortgages. And as you all know, that was where the epicenter of the GFC was. So but whenever you are in such a situation, I think that's the best place to learn the most, and also the best place to if you develop that survivor's instinct, then that holds you in good stead. So as I like to say, bear markets is where winners are made, right? So that's what happened in 2008 when I joined Morgan Stanley in London. um, I did that for like around a decade, transition across roles, but mostly on the debt side in fixed income. So from trading residential mortgages, securitizing them initially, to having to trade loan portfolios, billions of dollars worth across Europe that were left on a balance sheet because we could not exit. So had to manage their servicing and exits in an orderly fashion. Did that pretty well for 2-3 years, and probably did it too well, because then we started getting a lot of inbounds from other banks on the street, and also from the various bad banks that were set up across Europe. I then moved to capital markets to set up an advisory division to start moving a lot of these non-performing and capital intensive assets from your private markets, your public markets to your private markets, i.e. to hedge funds and private equities, etc. So, out of this entire conundrum of the GFC came up this opportunity that we then, I think, did pretty well. That's what I did for like a good few years. And then, funnily enough, at the end of that, towards 2016, is when a lot of this placement of assets with private markets, we were starting to finance them, and then that financing was converted into securitizations. So life seemed to have come a full circle from 2008 to 18, wherein I was now doing the same thing that I started doing in 2008. And that was probably a cue for me to start looking at something else, because the learning curve for me as part of the bank was fairly limited at that point. Probably I'm a bit inquisitive as well, so I always keep looking at other things outside of my area of expertise, and that's where then digital assets caught my attention. And even though initially I was skeptical, a couple of my friends from engineering with computer science backgrounds, they persisted that I should definitely give it a go, at least read the white papers and think of. While they understood the technology side of things, they wanted my view on how I looked at it from a financial standpoint, of whether a decentralized currency or a decentralized peer-to-peer cash system, does that make sense from a financial standpoint? And from that lens, it did really appeal to me, ever since what we had seen happening from 2008 to 18, which is bifurcation of the two-tiered society, wherein a lot of money that was generated in the system was going to the probably just the 1% of the world, whereas the 99% was left to pick up the inflation and also pick up the unemployment, etc. Right? So I looked at digital assets as something that could start transitioning a lot of control and power and also incentives back to the 99%, right? And that's where the bulb clicked in me, that this could be something, if done in a right manner, then it could revolutionize not just financial sector, but also the way we look at the way we look at multiple industries as well, where there is a lot of intermediation and a lot of juice gets lost in satisfying the intermediaries. That's when I decided to move back to India to begin my entrepreneurship journey. And funnily enough, as I said, starting points are always a trouble for me. So when I moved back to India, it was in the depths of the bear market. The Indian government also launched a banking ban on cryptocurrencies, and the regulations were also extremely against the ecosystem. But again, that's where then I traveled the world for like a good 18-24 months, met a lot of conferences, met a lot of like-minded people. And I would say I'm a lot wiser through that journey than I would have been if I was like starting off in the peak of a bull market, right? So yeah, but that's how the transition happened for me, and that's where I got quite fascinated by digital assets. And through COVID, then when scaling the business was becoming more challenging, then I transitioned into an investor role, mostly into angel investing, and that's how I then met the folks at Woodstock Fund. which is the oldest and largest Web3 focused VC fund to come out of India. And I decided to join them Q1 last year to become a partner, head up the institutional relationships, and also start putting a lot of institutional rigor around the fund to then go and raise our second fund as well, which is still in progress. So yeah, I'll just take a pause there and see if you have any queries, but that's pretty much how I would outline my journey.
Do you have any plans to move to Australia? Because then it would be a good heads up for me to potentially move somewhere else, right? If your timing is right.
I think in the long term, it all works well. So, if I'm coming in, probably in the short term, it's a good buying opportunity.
Exactly. So
I might actually be there in October because there is the T20 World Cup in Australia this time. So I might come for that.
That's right. So you kind of came across the technology around 2017, 2018, and then decided to move back to India and get involved. And then around 2020, you got involved with Woodstock.
Correct.
And maybe just give us a bit of background on Woodstock and what your focus is in terms of the kind of assets you look at. Is it purely Web3, or do you kind of look across the value chain?
Yeah, so we are purely so we are Web3 focused as a fund, and what that means is we look at investments both in private markets and public markets across the stack. By across the stack, I mean on the technology layer, which is your foundational layer ones and layer twos, etc. Then above that, you have your services or middleware, which is where you have your decentralized identity solutions, decentralized storage solutions, all those Web2 equivalents like your AWS, Infura, Bloomberg, etc., which need to be decentralized as well. So that layer, and then of course on top of it, you have your application layers, which primarily I would categorize into decentralized finance and NFT/metaverse. So we invest across the stack, and because this is more distributed ecosystems, our investments mostly happen to be in token formats, right? Now, having said that, we also appreciate that there will be a lot of overlap between what is getting built in the Web3 world versus the traditional markets, whereby you will need a lot of rails to be built for flow of data, personnel, and capital from traditional markets into the Web3 markets. So we also invest a lot into the rails that enable this transition of the capital and human resources. So fund administrators, custody solutions, payment gateways, anything that's around the periphery of Web3, but is essentially important for large amounts of capital, etc., to flow into it. We look at that space as well. And we have two funds. So fund one, which is where we started our journey, is pre-seed. So there we look for founder market fit. It's very early stage investments within that, with the lower check sizes. And fund two, which we are actively raising but also deploying out of. There we look at more mid-market positions, which is more later seed stage, Series A, early Series B, and also tokens that are already listed in the public markets.
Okay. And any particular, I mean, if you look at the thematics now, where would you say your biggest interest lies? Is it in the metaverse, gaming? What sectors do you see providing the best sort of opportunities at the moment?
Okay, so given what has happened in the last 48 hours, I would say almost the entire market is on a fire sale right now. Going a level deeper. So we are a very thesis-driven fund, and we have within our fund like 24 people within whom within that we have like 12 people who look at research and investments, and then bifurcated across technology, middleware, then across DeFi, across metaverse. So we have pockets of people who are looking at each of these places, and we try being very opportunistic in accessing opportunities across these layers. We were very early to get into decentralized finance as a sector. Even before the AUM within that entire sector was under $1 billion, we were quite bullish on it. Similarly, NFTs and metaverse, we were investing in late 2019, early 2020, when the terms were not yet, out in the public at all. So, but we don't try to corner ourselves by being very prescriptive in certain sectors. We try being more opportunistic. Now, having said that, where we are today in the market, I see a lot more value in the listed tokens market rather than the private markets, right? And the reason for that is there has been significant correction in the listed tokens market. And if you can identify some good blue chips or products, networks that have a product market fit, that are still showing growth in user base, developer base, and AUM, then from a long-term perspective, there are incredible opportunities to take care of at this point. I think it can still go down from here because there will be a lot of correlation to the wider markets as well, other asset classes. But I think we are at a space where there could be great opportunities in the private public markets. Private markets, however, have not caught on as well in terms of the corrections. And primary reason for that is there is so much capital that is available in the private markets right now, especially at early stages, that so that capital needs to be deployed. And when there is a need and necessity to deploy that capital, then it keeps the valuations also propped up. At this moment, at least in the next short to medium term, I see a lot more value in listed tokens as opposed to private markets. This can very quickly change within the next 3 to 6 months, because as liquidity dries up, as funds become more careful of not just throwing out term sheets all the time, then it will automatically reflect into the private market valuations as well. It's just a bit more opaque, so it takes time to catch up. But sector-wise also, Mark, I would like to add, so as a fund, while we invest globally and have made investments into 16 different countries across 4 continents, we do have a bias/USP towards India as a jurisdiction. So the team has arisen from India. I would say around 35 to 40% of our investments are backing founders of Indian origin. They need not necessarily be in India physically, but it could also be part of the Indian diaspora, say in Singapore, UAE, Canada, US, jurisdictions where we have backed Indian diaspora. So that's quite interesting and unique to us as a fund, because India's demographics and everything, all the key parameters are very bullish on Web3. A population where 1 billion people are under 40 years of age, very high penetration of internet and mobile phones, and at very cheap costs as well. The second largest startup ecosystem in Web3 world after the US, especially considering China has closed its doors to Web3, and also around 500,000 English-speaking developers who graduate each year, and developers are in short supply in Web3, I would say. So all of these factors make India very promising, and I would say that's a jurisdiction that we are quite bullish on.
It's intriguing to notice that the top 20 users of this space, not investors in the space or holders in the space, but actually users of cryptocurrencies and their solutions. Number 1 back in September was Vietnam. Number 2 is India. And number 20 is Afghanistan. And America sort of slips in there at about number 8 or 9. So what we're seeing is the developing countries adopting this first and with gusto. What's your view on that? And do you think that's going to continue for some time? And do you think that's because there's less adherence to the requirement of having institutional intermediaries doing transactions? What are your thoughts around that?
So that's a great point you have raised, and I think we need to take a look under the hood here in terms of what Web3 and decentralization is trying to achieve. Right, it is trying to remove the necessity of intermediaries, or at least reduce their impact, and also make transfer of data and value a lot more efficient. So if you look at US versus developing countries, then I would say the intermediary infrastructure and also transmission of data and value within developed countries like the US is probably pretty a lot better than it is in countries like Vietnam, India, and Afghanistan, right? Now this technology has given the people in these developing countries a tool with which they can do a lot more efficient transfer of data and value, which is why the uptake has been so tremendous. And also because these countries have a lot of restriction on or a lot of capital controls on their local currency. So things like remittances or even sanctions, etc., can be quite challenging for a lot of these nations. So utilizing blockchain as a technology and digital assets as a tool allows for people to stay above water to an extent. And if you look at also countries like Indonesia, Thailand, etc., then there the economy, especially post COVID, resulted in a lot of unemployment. A lot of people in especially jobs such as waiters or maids, etc., had to forego their jobs and had to sit at home. So a lot of them took up to playing say play to earn games like Axie Infinity, right? And they started acknowledging the fact that this is something real, and this is not just a game I'm playing for entertainment, but if I do well, then I can actually earn digital assets within here, which I can then convert into my Thai baht or the local currency, and sustain my livelihood and that of my family. So I think people lose focus on these aspects as well, where digital assets are allowing for a paradigm shift in terms of how people look at means of livelihood, how they look at sustenance, and these questions matter a lot more in developing nations, and which is why I think there is a lot more uptake within the developing nations for these assets.
Yeah. Hey, Prashanth, I had a question, and this is interesting from a sector perspective. You mentioned sectors, and we went down this path in absence of a typical S&P 500 or any of the indexing sort of mechanisms. And I think CoinDesk is looking into like DAX, which is the digital asset classification system. In absence of all that framework, we went down this journey like 2 years back in classifying this, and we revisit this every 4 months to 8 months. And what was early days 7 sectors, we have now down to 17 sectors as we looked into this, right? Which is layer 1, layer 2, capital markets or crypto capital markets, looking into data, looking into some of the NFT platforms, Web 3.0 platforms, and so on and so forth. So these categories sort of classify and grow over time. But that's the token space. So I view Portal, what we're doing in terms of token investing is other spectrum, and what you're doing is early stage, which defines these categories that come down the stream for us. So I see what you've done, and having known Woodstock, you and your founder, you and Pranav and the founders, just brilliant heads down, work, who's looking into the fundamentals, looking into the basics. And so I see you as the front end, which is, bearing the brunt of figuring out what this future sectors could be, whereas Portal is looking into this as sectors mature, what we do in terms of token investing. Are we on the same page in the sense that, when we look at the sectors, which is rather matured, looking at the data, looking into few things, whereas you're looking at things even before the surface in our world? Love to get your perspective on that. And I think the lines are blurred because now you have funds which are hybrid funds, which look into VC plus token. If you can shed light on that, because that's an interesting and a complicated topic, at the same time.
Yeah. So I think a couple of ways to skin this cat in a way. Yeah, and yes, funds are getting more and more hybrid. Even our second fund is, I would say, a hybrid fund. Although we don't day trade any of the positions we take in listed tokens, we still take them because from a thesis standpoint, it makes sense to us. Where we are in this space right now is, if we go from bottom up of the stack, then the technology layer is a lot more developed and consolidated now than it was 4 years ago, right? So you have your layer ones, 5 to 8 of them, which you can tell looking at them now that, okay, as this space proliferates over the next decade, 2 decades, then these 5 or 8 layer ones are probably the ones which will get the most market share at a technology level, right? These could be your Ethereum, Solana, Avalanche, Elrond, and a few others. That was not the case 4 years ago, because then most of the other layer ones that had come up at that time had not developed the user base or the developer base, and did not even have like strong capital commits behind them that we see with a lot of layer ones today. It might change quickly, but I think the network effects have started around them, right? So what that therefore means is, if you are constructing an index today, then you can be, I think, at least in the short to medium term, a lot more surer about the infrastructure names within your index, because they are what relatively in this space you would call as blue chips at this point, right? And I see a lot of capital as capital and liquidity succumbs further over the next 3 to 6 months, I see within the crypto space a lot of this capital gravitating towards these blue chips, because layer ones, the utility of the underlying cryptocurrency is very native to those layer ones, right? So there is very natural utility for wanting to hold that. It's used for paying any transaction that happens on that particular chain. So there is a very natural utility right there. As you go slightly higher up, then when we come to middleware, I think you are seeing offshoots of certain winners or like category leaders here. Like in the Oracle space, you have Link, Band, and then in the storage space, you have your RV, Filecoin, etc. Then in the indexing space, you have Graph and Covalent. So I think like there also you're seeing offshoots of certain. So I would probably, like in your traditional terms, you may want to call this as like mid caps for now, right? And there can be like indices formed here as well, but probably not as, they may not be as consolidated as your layer ones. And then finally, when you go to the application stage, this is where I think a lot of opportunities and alpha will be generated in the long term from where we are today. Because if you look at internet and where we are now, even in the internet, the underlying layers, the technology, the scaffolding has to first develop before we create a lot of user specific applications that people will want to take up, right? But it will happen eventually as Web3 proliferates into the masses. So I think that is where it's probably the small caps is what I would like to call them now. Maybe very crude in terms of how I'm categorizing it, but that's how probably I would look at it. Over the next 10 years, a lot of us will even stop worrying about what's under the hood. We may be even looking at, we may be accessing applications like a decentralized social media or a decentralized e-commerce platform, where underneath there will be a blockchain technology, there will be middleware services, but we will not even touch them, right? We will just be accessing the user portals, and it's all about the UI, UX, total addressable market, and all the crazy stuff that we do from a Web2 VC standpoint. But I think we are still away from that. So that is where I think once the market settles down, I think a lot of focus from VCs as well will gravitate towards the application stage.
So you mentioned earlier how one of the things you were looking at was what you called that bifurcation of wealth, where where the Gini coefficient, so to speak, with the gap between rich and poor was just seemed to be continuing to grow, and it's most prevalent in emerging markets. I mean, in my country of birth, South Africa, it was probably one of the highest in the world. I think the gap was as high as almost like 90%. And I think one of the things we've seen with COVID and the lockdowns and so on was an increase in this, because you had a massive amount of wealth transferred from Main Street to Wall Street and Silicon Valley, in terms of mom and pop shops stayed closed and the big retail outlets stayed open and so on. So you talk about the democratization, particularly for emerging markets, which account for probably north of 60%, maybe even closer to 70% now of the world's population, but a lot lower in terms of the world's wealth. And given your background in traditional finance, having more experience in the securitization, M&A, does it not make sense for you as a fund to be looking at potentially financial applications that could connect, capital that's looking for yield with factors of production in places like, whether it's in Africa, India, in South America? China is a bit of a difficult case because of the regulatory issues. Because it seems that if you look at countries that are embracing Bitcoin as legal tender, it's emerging markets, particularly South America, and we see now in Chad and Niger and some other places. So I just thought I'd get your thoughts in terms of, we've seen the rise of DeFi and then smart contracts and then NFTs, and now the themes are towards gaming and potentially fan reward tokens and so on. But in terms of more practicality of actually connecting capital with small businesses, do you see a place for that? Are you seeing any projects that look interesting? Because I think that will be not only an early adoption, like we saw M-Pesa in Kenya and Tanzania, where it jumped right over, it leapfrogged the banks, and everyone just does cell phone banking. They've already adopted it because it's just so much cheaper and easier.
Yep.
What are your thoughts there?
Yeah, so that's an area that's of a lot of personal interest to me, in trying to see how best we can bring this technology and the access to and the cheaper capital available here towards emerging economies. where access to capital is limited, plus also wherever the access is possible, it's at like very high interest rates, right? And I think the technology is there to seamlessly allow for access to this cheaper capital, because DeFi is like the technology which is at a global level. Anyone from anywhere can lend into these protocols, and effectively you have to just create a tool for all these smaller businesses and probably people with low access to credit to just tap into the DeFi protocols and get access to this credit at a lot cheaper rates than where they are in their countries. Technology wise, it makes a lot of sense, and I think it will happen over the long term, right? The problem, however, here is if you just take South Africa or even India as an example, most of the businesses and the employees, etc., are heavily reliant on the local fiat currencies, and accessing your US dollars or any of your digital assets requires you to then create off ramps to convert them into your local currencies, right? And the regulation and the policy today is not evolved enough to dictate what can or cannot be done. So I, as a small business in India, cannot technically access DeFi and take dollars from it and convert it into rupees and use it for my working capital or for my personal loan disbursements, etc., because I'm answerable to the central bank as to where my capital came from, right? And I have to file in significant amounts of paper. I have to ensure that the source of capital has been vetted from an AML standpoint, etc. So I would say the friction lies in the regulatory side of things, and that friction, I think, will struggle to go away in the short term, because A, there is a lot of inertia in that space, and B, there is a lot of disincentivization from the incumbents to enable this, right? So that is the challenge we face when trying to marry DeFi with the smaller businesses. To me, it's a no-brainer that it should happen, because DeFi, decentralized finance, should not be a conduit for people to just speculate and do yield farming and other aspects. It should be seen for the evolved technology that it is, and that can make lives of people and small businesses a lot easier in a lot of these developing countries. And I think we will get there, but the regulators, I think, have a very big role to play in enabling it.
Do you think it'll be CBDCs that enable that? Because then you could technically go from CBDCs into stable coins into DeFi. Do you think you'll be able to bridge it like that to kind of offer on ramp?
See, CBDC is in a way antithesis to Web3, right? Because CBDC is nothing but a creation of the same fiat currencies by the central banks with a lot more oversight than what they already have. I see benefits of CBDC, definitely. I think it can be integrated into the DeFi ecosystem as well. But it should not result in, again, having the same set of, limiting aspects which prevent, say, if you have a CBDC in India, and then if I want to use DeFi to, borrow from the protocols and then bring it into India in CBDC format, if the same issues that I raised previously come along with the CBDC, then we have not really solved for the bigger problems that are out there. But if we have a newer framework and policy to say, okay, well, whoever wants to lend into this protocol globally, maybe they can be within a permission network. You KYC such people through on-chain identity, and then you utilize that to withdraw into these countries under the regulator's purview, and then you convert it into CBDC because that's the local fiat currency, which can be used for working capital and for paying salaries. I think there is a path there. There is definitely a path there, and the technology is not the problem here.
So this is intriguing, because what we're hearing today, I'm looking at the screen, and I know many of the names here, and many of the names are sophisticated investors intrigued about this space. What we're hearing here is we're hearing a strategy by a venture capital group that are mostly in liquid tokens, which is intriguing, because normally venture capital is locked in early stage and there's no liquidity. So we've got venture capital in liquid tokens. We've also got venture capital that's saying, no, the areas that are booming in this are the early adopters, and those are India and Vietnam, Indonesia, et cetera, et cetera. And so we're looking into that space because it's booming the fastest. And we're also seeing another door of entering and investing into this space. I've often said there's 1,000 doors to enter this space and invest in it. But what's intriguing is that you're global, you're liquid, you're a venture capitalist, and you've cited the fact that the rapidly adopting areas are going to be early stage or developing countries. Now, we've seen recently that the number of users last year went from 120 million to 300 million users, not investors, users of the space and the solutions. And that's getting projected to be another billion over the next 12 months, go up to 1 billion over the next 12 months. Do you think that next 700 million is also going to be mostly from these developing countries? And if so, what are they going to be using these digital assets for the most, do you think?
Yeah, I think, definitely a lot of the growth in terms of the user base can happen from developing countries. And this is across large swaths of Asia, Latin America, Southeast Asia. I think these regions can contribute a lot towards adoption. And the use of these assets, to me, primarily at this point is mostly speculative, right? And I think that narrative also has to change, whereby see, if you are giving, if like I said, you're trying to give power and control back to the communities and the users, then you need to have these communities and users rise up to the possibility that they have this control as well, right? And what that means is you need to see a lot of proactiveness in trying to understand this space from first principles. Look at it as something that could shift the paradigms in terms of how the internet is today, how financial infrastructure is today, and appreciate the fact from first principles. And this is important because a lot of the retail folks, especially, enter this space with a speculative mindset, right? And when you enter something with a speculative mindset, then you are a good proportion of them might just end up becoming exit liquidity for a lot of smarter people in this space who are able to time the markets better, right? And then you hold a grudge against the space for having lost your well-earned money because you entered into it from a speculative mindset. And look, I mean, all of us go through this journey. I'm not saying, I mean, we hit a home run with every investment we make, and it happens, right? But it's important to I think appreciate the technology for what it brings and what are the shifts that it can generate. So trying out the newer products, trying to understand it from first principles, understanding it from a macro and microeconomic standpoint as to why it is important to for Web3 to proliferate. How is it giving control back to users? Why is privacy important? Why is controlling your data is important? Why should you want to economically get an advantage from the growth of the platforms that you spend most of your time in, right? It's very important for these things to be understood, and for communities and users to rise and ask the pertinent questions. I think a lot of space gets lost in just the speculative side of things, which I think needs to change. And most of that change typically happens in bear markets.
So let's address one thing, which is the talk of the day. Which is Terra, right? And I spend pretty much all day dissecting it and understanding it. And I'm also, in preparation for this call, Prashanth, I was looking at, again, two spectrums, right? One is our risk models. So we, of course, have risk models. We go through an entire process in terms of distilling down the tokens and figuring out as to what is the right that adheres to our thesis, looking into the longevity of these tokens, looking into some of the element of maturity. And what Terra went through, which when it was announced, and I think I was pretty, the Terraform Labs in general, what they had done with Mirror Protocol back in the day, which is synthetic securities, which is ability for them to be able to create an instance of an Apple stock or a Tesla stock. That was the initial thesis. And then they had Luna, and they had the entire journey around it. So it's not like they're new to this. But if you were to look at where they are today and what they have gone through, And I spent a lot of time actually in the past 2 days looking into this perspective of, is this the right monetary system? Is this the right model in terms of what they have done in terms, in terms of having 3 token models? One is a collateralized model. One is basically the ability for them to, have a balance between Luna and Terra. As a token investing entity that Portal is, it would have not made the cut for us in the sense that it's new. There are all kinds of risk associated with it. There's the liquidity risk, there's technical risk, there's all kinds of elements that we would say, we don't understand this, so we're going to stay off this, no matter how much upward potential it may have in short term. But you as a venture, it's a lot of potential. It actually had a lot of promise upfront. I'd love to get your take on this, because there are 2 sides of this equation that we look at. One is, if I had invested in Terra back in the day, which did well, when they were doing this mirror protocol, I think Galaxy Digital, which is Novogratz, made some significant investment in that space. But as they begin into this whole element, did they lose their way? Did they make a mistake? And it's okay, it's an experiment. They're still learning the space. Just to get your thoughts as a VC, because as a token investing entity, it would not pass that initial second step for us. Looking into this, at least from a, maybe you can call us conservative or whatever the case is, but we would do the due diligence on this and say, this is very high risk, and maybe we'll have a small percentage of our small cap sort of portioning of how we do with this. So love to get your thoughts on this.
And just for the audience, before you jump in, Terra Luna is currently down 99.5% off its $98.15 position. So it's now sitting at 45.6 cents. So certainly it has fallen and it's decoupled. And so we're intrigued to hear what your thought is of how it's broken away and decoupled and what you would do there.
This is eerily similar. Again, going back to 2008, this feels like Lehman Brothers all over again, but in our Web3 space, right? Right now, they are reliant on bailouts and some sort of like market confidence to come back into Luna/UST for them to recover. So I don't know if they will or not, but as a fund, we have zero exposure to Luna and UST. And that was also a fundamental decision for us, because the ecosystem is good. We have made a couple of investments on applications that are built on top of the Terra ecosystem, and they have a very vibrant community. They have very good founders who have adopted the Terra blockchain to want to build within the entire Cosmos ecosystem, right? So we feel for them, and we are reaching out to them to see how best we can help them navigate this tough situation. But that's a separate side of the story. With Terra, what people fail to understand, I think, is and this is something they have been pretty vocal as well. They are trying to create a decentralized algorithmic stablecoin, right? And it has not been successful in the history yet of such a currency navigating through tough times. See, these currencies maintain pegs very well during bull markets when things go well, but maintaining the peg when there is market correction and when there is a run or when there is loss of confidence is when their true strength emerges. And but one of the reasons we never got into that is for this fundamental reason that we don't know when the markets will turn. And when the markets turn, if there is a loss of confidence and if the peg starts losing, which it did with like very small proportions to begin with, then what happens if there is a run? What if a lot of people who are sitting on large amounts of UST want to sell out of it, right? And the way you then sell out of it is in the process you are minting tremendous amounts of Luna, which is the native currency of the chain that is keeping it pegged, right? So and that's pretty much what happened. And even though 1.5 billion worth of reserves were sent to a market maker to try and maintain the peg, it just became too difficult against market forces and also potentially some some larger institutions as well, who may have been incentivized or may have been holding a grudge, I don't know, but who aggressively also went about shorting and getting arbitrage rewards in the process. But either ways, right now, that calls into question the entire algorithmic decentralized stablecoin narrative that is out there. It was doing tremendously well. It's struggling right now, even though the Luna is at like 45 cents. I think the peg is, I think, somewhere at 75 to 80 cents, if I'm not mistaken. And it's come back from 50 to 80. I think the immediate strategy is to restore the peg in some shape or form. But for that, they will probably have to wait for a lot of sellers to exit first before they infuse the market making from their side. Once you restore the peg, then you try building confidence back in the token, right? And it's not easy because a lot of volume has left Anchor protocol that Nitin was referencing to. It was paying like 20% interest rates previously, which is what had convinced a lot of people to put money behind it. Again, if it's too good to be true, then it's probably that way, right? Now, how will that capital be recovered back to, and how will the 20% be paid going forward, right? So I think they have like a lot of fundamental questions, and it's a non-zero probability right now that this goes down a Lehman Brothers route. The problem there is for like some of the ecosystem applications that are getting built, and how do they go? Maybe they can just transition to another chain and start rebuilding there. But the other problem is how will this be looked upon by regulators, right? Because you have now a token that has lost 99% of its value within a couple of days. A lot of disgruntled people, both on the retail side and institutional side. And regulators have had an issue with decentralized algorithmic stable coins as well in the past, especially the SEC. So needs to be seen how they try to come back at the system now that their worst fears have come true. So yeah, I mean, I wish that entire ecosystem all the best. Happy to help. We are reaching out to see if we can help in any way as well, but it is an experiment. It was an experiment, right? So when you are dealing with experiments, I think, again, coming back to retail investors, you have to only put in as much money as you can afford to lose. And it has to be very important that you take profits along the way, because you never know when these things turn, right? And they go sour. So
Yes.
having emotional attachments to some of these things and trying to put hard-earned money, significant amounts of it, we are still not there yet, right, as an ecosystem. So it is something definitely people should have as a part of their alternate portfolios, the overall ecosystem. But does it demand that you sell your house and put 100% into it? No.
It's a very good point.
No, yeah, I think that's a good point. It's very well put.
And so we have, needless to say, a whole lot of investors with us, and we don't make investment advice in this space, funnily enough. But what
I would like to say neither do I. So I just have to put that caveat out. Okay.
Thank you very much. We've got the disclosure. But what is interesting is when you look at the marketplace, of course, it's gone through an enormous downturn, which of course just signals opportunity all over the place. And the market seems to have dropped sort of 30 to 40% across the board in recent times. What do you think are the standout opportunity sectors now that it's gone through that kind of readjustment? The ones that you'd step into going, well, they were overpriced before, but I think they're really well priced now.
Yeah. So to me, wherever you have evidence of product market fit, where there are ample number of users, developers, and applications, and that rate of increase is still steady, and you can track a lot of this on chain, on the blockchain itself. So those will be like ideal opportunities from a long-term standpoint. And these would be some prominent layer ones. These could be the newer layer twos that have come out. These would be a lot of middleware services, which will only consolidate with more blockchains because they are agnostic across chains. And this could also be certain blue chip applications that have shown tremendous ability to garner market share. Either decentralized exchanges or aggregators of exchanges, or lending protocols, or metaverses. There are like your first few who have come out and have built and have like a substantial user base, have a lot of traction. So it's like I think these are the categories where you should be looking at. The other way of looking at it in the short term is if newer capital comes in, which I don't think will be retail right now, but will be more institutional, then where is that capital expected to go, right? It will not go into like newer applications or like the ones where users have not yet been sourced. They will go into where they see certain names as proxy for Web3, right? And those would be your underlying blockchain layers. If you look at any of the alt layer ones, they've all come down anywhere from 70 to 85% from their all-time highs, right? So this could be a great time for you to start accumulating it with dollar cost averaging in mind. Of course, they can go down another like 30-40% from here as well. But if you start dollar cost averaging now, then you can start building good positions here. And if Web3 is to become a reality, which we think it will, then the layer ones and some of the middlewares are absolutely necessary, and they are not going out anywhere. So they would be like, I think, the ideal places to focus on in the short term.
No, that's great. So tell us more, Prashanth, what's next for Woodstock? I mean, I know I've seen, again, I've been intimately involved with the growth. Adam, a good friend of mine at IBM, is now leading your practice in the US, and I've seen some amazing progress. Your move from Singapore to Dubai, which I think you guys did this before Dubai was cool, and now Dubai is attracting all kinds of investment in Dubai. Tell us a bit more in terms of overall vision and perspective, that you seem to be a step ahead. And I've seen this. I'm not just saying this because you're here, but I've seen this, like you moved to Dubai before Dubai did all these things, and now it's attracting massive investment, massive movement of not just capital but talent in the country. You're staying ahead of having the right formulation of thesis, going after Web3 NFT, like focusing on 2 years back before it was cool. So what is the secret?
I don't know if it is a secret as such, but I would say everyone in the team has very high levels of conviction that Web3 is the future and will be a sustained reality. And when you come top down from that perspective, then you know that whatever you do is towards this end goal of reality. And when that is missing, then you can get a bit sidetracked, and we don't let ourselves do that. If you look at when the fund started, early 2019, it was in the absolute pits of the bear market. But that was probably the time when we made our best investments as well as a fund. We just try to keep our head down, not let the volatility in the markets impact us. Just define our thesis, follow our thesis in the best way possible, have the right structures and policies and compliance in place to give our LPs the right satisfaction. So I think that's pretty much it. And I think we have a good set of people at the top who come from a lot of business acumen and a lot of entrepreneurial and corporate experience, who set the tone. And then we are ably assisted by a lot of young folks in the research and investment side who are extremely hungry and who want to see Web3 as a reality, right? So I think it's a good combination there. Immediate target for us, I would say, is to close our second fund, which we're halfway through, and just keep deploying. And we are having a bunch of calls to see how we can take advantage of the recent market correction as well.
Just from my point of view, something I'd be interested in is: are you seeing in this recent correction, are you seeing investors or potential funders of the fund, investors in the fund, pull back, or are you seeing liquidity dry up, or are you still seeing a lot of institutional money? Because we've seen, in setting up a new fund, we've spoken with administrators, and there's a lot of new funds coming in the listed space. We don't really deal much with the VC side, but there's a lot of new investors coming. We see the likes of, the bigger houses, Brevin Howard and Bridgewater and Point72, that are setting up funds. They wouldn't have done so on a whim. They would have been a long sort of process. So do you still see, as we do, a lot of institutional money coming into the space, or do you think that this correction is maybe given people a bit of a zap to pull back?
So a lot of money is already here, right? In my opinion, there is more money here than what the space needs. So to be very honest, and right now, a lot of them have made up their mind that they want to invest. And with what has happened in the last couple of days, I think a lot of them will start taking significant positions, pretty much in the way that I outlined, right? So I think money will keep flowing, because at this point, where else can if you look at that, if you look at it like a traditional fund manager or an asset allocator, then digital asset has probably provided the best returns in the last 5 years. It's become more of a reality now. It's the future. You see all institutions, endowments, regulators, everyone looking at it now. So you have to allocate some aspect to this, and you would much rather allocate now rather than 3 to 6 months ago, right? So I think money will keep flowing. It may not flow immediately in the next couple of months, because everyone wants to see where this is, how much lower this can go. Will the Fed follow up with another 50 basis points of rise next month? And also, do we see any offshoots of recession coming on the back of it? Or, and then midterm elections, right? Midterm elections is, I think between now and then, there will be a lot of back and forth in terms of how people look at this space. But in my opinion, if there are any offshoots of recession, then no president wants to go into a midterm election with that on their head, right? So there will probably be another QE if that happens. So I think these are like a lot of unknowns at this point in the short term that need to be answered. But capital is there, it's waiting, and a lot of it will start coming back into this space.
Yeah, I'd agree. Look, I think with what we've seen, given the jobs data we've seen recently, and I think you'll see inflation taper off very quickly going into the second half of the year. I think the recession is guaranteed, particularly in the US and Europe. When that happens, I think the Fed will have pause. They'll be able to pull back and to not maybe hike as much. The market went from expecting 3 or 4 rate increases to expecting north of 10 in the space of like a month. So I think there's been an overreaction. And risk assets, I think what we're hoping for is this dislocation between crypto and digital assets and tech stocks, because they just, Ethereum grew its earnings, I think I spoke about it earlier, at like 500% last year. It grew, it's $10 billion now. Like whether it's Facebook or Netflix or anything, they're all going backwards, right? And I think Web3 is facilitating a lot of that. They're taking shots at the incumbents, and eventually you will see social media operating on a decentralized blockchain. So I'm of the same opinion as you. I think this is probably one of the best buying opportunities we might have for a long time. I do think it could be a bit of a rough ride for a while, but if you look through the cycle and you look at the underlying news flow is very positive. As you said, there's more than enough liquidity and capital there. We see on a daily basis headlines of either senior executives leaving established traditional finance businesses and so on and setting up and moving into the space. So there's real opportunity here. The government regulation has always been a bit concerning, but it seems that particularly in emerging markets, there's a rush towards adoption. And I do think that you're going to see continued growth and interest because the underlying news flow is positive, even if the perception is negative. So I'd say, yeah, given what we've seen transpire over the past, particularly 18 months, 2 years ago, no one had really heard of NFTs or DeFi. 2018, 2019, the world was a very different place. And this is, the one, if I could say the only good thing about, COVID and all of that was that it accelerated adoption in the space. It has been really good.
Definitely.
And that's not going to, those trends are firmly intact. They're not going to be reversing. In fact, most corporates now, anecdotally, my sister works for a big recruitment house, and most corporates are now offering their staff pay cuts in return for being able to work from home permanently. And that's kind of like these trends, I think, are not going to reverse. I'm also of the same opinion as you, that it provides a much more democratization of access to capital, particularly in the emerging markets where you have, Merrill Lynch wrote a report, or the old Bank of America Merrill Lynch, a while back on their thematics called The Bottom Billions, which talks about these billions of people in emerging markets that are starting to formalize and also want access to banking and, all of those good things. And that's where the growth's going to be. You've seen it when, even in times of duress, when the markets have tanked, even now, the growth in wallets continues. The growth in activity continues. It's not like it all drops off and disappears. In fact, it continues. And I think, the government overreach we saw into private banking or private bank accounts and censorship and all of that has accelerated this. People are being forced now to look at the space in a lot more detail. So I'm the same as you. I'm long-term bullish. Short-term, short-term, you don't want to be the first person out there on the dance floor, right? But longer term, I think it's going to be very much what we believe, which is going to be world changing. But how can we get hold of you if we need, Prashanth?
You have my email anytime. Then for personal discussions, or I'm not very active on Twitter, unlike most people in crypto. But yeah, but I do post on LinkedIn as well from time to time. Yeah.
So we can share your email address with when we
yeah, sure, definitely.
And it's woodstock.us, or what's the?
Oh, it's mine is woodstockfund.com.
Got it. Okay. Got it.
Cool. If there are no more questions, I think so thanks very much for your time. We really enjoyed the discussion. It's a bit of it's always a bit difficult being upbeat in markets that are being beaten up. But I think, you know, as we've seen in the past, like now, I honestly believe now is in this market is where you'll see many, you know, a large amount of wealth created by people that are brave enough to get involved.
That's true. No, it was great. I mean, I enjoyed the conversation. We could go for hours, of course, but thanks again, Prashanth, for your time, and looking forward to again meeting you soon.
Thanks to all of you as well for having me, and hopefully that made sense.
Yeah.
Very much so. Thank you. Good. And of course, the other thing is that this will be recorded, so it's available if anyone wants to share it with friends or associates along the way of any particular area. Over to you, Mark.
Yeah, thanks for your time, guys. We really appreciate it. You know, we're in the process of launching this new fund, Radiance, which is obviously a difficult time to launch a fund, but I think the best businesses and funds are born in winter. And I do think right now, getting in at these levels, we've been looking at opportunities that we were bullish on, literally 60% higher than where they are right now. So I mean, it becomes a much more of a no-brainer to take a chance at this point in time and ride some beta, which is a very much it's a significant part of performance. Alexander has asked, what's your favorite early project in the DeFi space? I don't know if you have any view on that, Prashanth. I think looking at some of the decentralized nodes, the likes of Helium and Rocket Network, and that, for me, they stand out as quite interesting. But
yeah, I think, you know, MakerDAI has been a test of time. It's been there for quite some time, and I think that model, you know, over collateralization, not the most efficient capital, but I think, to me, early days of that has still been tested. I mean, Aave is great, lending Uniswap, you know, Uniswap of sorts. So automated on market makers, DEXs, stable coins are really the staple of the, you know, of the industry, regardless of what Terra has tainted, at least in the short term, the image of these, you know, these projects, I think.
Yeah, DeFi space is, you know, going through a bit of, I would say, re-identifying itself, and a lot of projects like Maker, Aave, Synthetics, etc., which were the shining lights of the previous DeFi boom. I think they will continue. The longer they stay and attract AUM and stay without getting hacked, I guess they will become more and more valuable over a period of time. But there is a regulatory overhang around DeFi at this point, I would say. So that needs to be resolved for DeFi to take the next step. In terms of where I am quite bullish on DeFi, I would say two spaces. One is in the options and derivative space. Not bullish in the sense that I've identified something which I think will scale to like billions of AUM very soon. There are challenges in pricing, margining, and also making liquidity efficient with option protocols on chain. I think some of that needs to be resolved, which I'm keeping a close eye on. The second aspect is in projects like your Centrifuge, Goldfinch, etc., where they're trying to bridge real world assets to DeFi, which is what I was talking about earlier, that how do you use liquidity and technology in DeFi to benefit real world use cases, right? As opposed to just yield farming and liquidity mining. So I think that is another area I'm very keen on, and want to you know, look at some good projects there. But again, like as I said, regulation is a big overhang over all of DeFi right now, and that needs to be resolved in some shape or form.
And then I think there's one last question from Daniel. Wants to know, wants to ask a question about digital asset valuation. I don't know if you want to unmute and ask the question, or you want to type it in, Daniel.
Oh, thank you, sir. Sorry, my computer's down, so I'm using my smartphone. Apologies for the informality. But yeah, I just, my question with the work colleagues around me is about your work. What is the best method of valuing digital assets? Because, you know, you can value like the monitors around me or the smartphone we're holding, and look into the company, see whether overvalued, undervalued. But how does one go about that when it comes to digital assets? Right now, the best method I'm seeing is the growth in the network. I believe, like you mentioned a little bit earlier, sir. But apart from that, I don't know what is the best form of valuation when it comes to cryptocurrencies and the larger cap ones.
Yeah, I mean, I was hoping no one would ask that question because it's an impossible one to answer. But Daniel, yeah, see, there are multiple ways. None of them have been like set in stone yet. So as opposed to valuing your companies through the traditional discounted cash flow methodologies or even your bonds, etc., digital assets haven't yet evolved to an extent where you can adopt any traditional or even newer valuation techniques. There are certain ways that you can get a sense for it. So if you look at underlying protocols or technology layer, then Metcalfe's law is, I think, a good way of gauging the valuation. That basically says that the valuation of a network is directly proportional to the square of the number of active users on it, right? And this is something that has been proposed and accepted for your social networks as well, like Facebook. So that is one way. It does not get you to a valuation, but you can use that as a metric to compare across various blockchains, for instance, right? Depending on how many active users there are on each of these chains, and relatively, one of them is valued at X, how much should the others be valued at from a similar standpoint? The second one is when you come to DeFi, then I think there are protocols like your Sushi Swap or Aave, where if you own the token, then a percentage of the fees generated by the protocol go to you as a token holder, right? So then if you can project the revenues being generated by the protocol, then you can also calculate how much of it is coming to the tokens, and then it becomes a very discounted cash flow kind of a methodology for you to value these tokens. The part that is that again will be very variable and volatile here is what are the growth metrics that you assign towards the projections of these of the fees on these protocols, right? So that I might have it growing at 10% a year. You might have it growing it at like 1,000% a year. So that again brings a lot of variability. Finally, when you come to NFTs and metaverses, there is an element of Metcalfe's law there, but also you can draw parallels from your physical world as well, right? If there is like a music NFT platform, then you can look at how much is it trying to disintermediate, how much of whatever it's trying to disintermediate, what is its value today. Of course, it can't be close to it in any shape or form, but at least you know what is it going up against, right? And that's another part. It's not an easy question to answer at all. There has to be an element of relative mechanics that you have to utilize, and a lot of this also comes from having spent a lot of time here and having a very strong gut feel that you can generate, because you just seem to know that, right? But this is very much like the early internets, early to late to 1990s. Pre-dot-com bust, no one really knew how to value a lot of the companies that were coming out at that time as well, right? Significantly volatile, no real calculation metric, but you just ensure that you are on the right path, and keep taking profits regularly, and just keep doing a lot of analytics to make sure that what you anticipate as growth for that product or network is indeed happening, and is happening better than its competitors, right? I think that's probably how you go about safeguarding yourself, because there is no right or wrong set in stone answer.
Yeah, I'd agree with that. And I'd say, just to add one other thing, is there's a lot of good ideas, but ultimately you have to ask, how does this convert into profitability? How does this become, as you said, something that generates profitability and free cash, rather than just continuing to generate, let's say, more tokens in this token? So that's something that I look at. We have something we call the greater fool theory, which means we just look at what we think we can buy something for, and hopefully someone else will think it's worth more, and we can sell it to them for higher. That's part of our investment process. Right. I'm kidding, by the way, it's a joke. Well, thanks very much, guys. I think that just to finish up on that, the one thing about the space that you realize when you look into it and you start trying to figure out how to value things from a tokenomics point of view is that it's not set in stone. It's basically there's a lot of it's a new frontier, and as such, people are going to be like, there's pioneers in the space, and as time goes on, some of these valuation metrics will become more acceptable and understood and adopted. And I think part of that's part of what you're doing and what we're trying to do as well, Prashanth. So thanks very much for your time. We really appreciate it. And yeah, we'll send out the recording after this for everyone.
Thanks for having me.
Pleasure.
Okay, thanks, Prashanth. Good to see
Okay,
you.
guys.
Thank you. Have a nice day,
Bye,
everyone.
guys.
Thank you, everybody. Good to see you all.
Thank you, everyone.